Hey, what's going on, everyone? Today is the last video for year 12 accounting. What a journey it's been. We actually have done everything, and today we're just looking at evaluating performance, and this is going to consist of ratios. So before we start, don't forget to like, share, subscribe, and you've got all the content here, so you can just go back and watch it as you need to for revision. So hooray. Or, pass it to a kid who's doing accounting next year. I don't know. But let's jump straight into it. So we're going to look at ratios, and we're going to divide them up into profitability and liquidity. And from the profitability side, we're going to have return on owner's investment, debt ratio, return on assets, and asset turnover, which measure how profitable we actually are as a business. And this mostly relates to risk reward and essentially earning revenue. On the other side, we're also looking at expense control, which will be represented by gross profit margin and net profit margin. After that, we're going to be looking at liquidity, and this is going to divide it up into level of liquidity as well as the speed of liquidity. So our level of liquidity will be working capital ratio, quick asset ratio, cash flow cover. Meanwhile, our speed of liquidity is going to be the inventory turnover and the accounts receivable turnover, along with the accounts payable turnover. So we're going to go through all those ratios. So the general structure will be, here's what it's measuring, here's the formula, and after that, here is what we're looking, like how we can improve it. And then we're going to wrap everything up by actually looking at our vertical analysis, and this mostly works for the income statement, so that's what we're going to run off, and I'm going to explain the links into there as well. So let's jump straight into it. So the first thing we're looking at is return on owner's investment, and this looks at how much the owner would make from their capital. So when we say that, the formula is net profit over average capital. And this tells the owner, hey, is this a good investment? And ideally, you want a higher return. How do we improve this? Quite simply, we decrease the amount of capital within the business, so through drawings or leverage more debt maybe, and increase the net profit. And we're going to look at the net profit strategies later, so don't worry. Now, the next one on the other side is the debt ratio. This is total liabilities divided by total assets. And this tells us how much of the firm's assets are financed by debt. Now, a small little sidebar here. This is inverse proportion to debt ratio with the debt ratio is inverse proportion to return on owner's investment. And this falls in line with the idea of high risk is high reward. And the way to improve our debt ratio is to pay off debt, purchase assets. So either lower the amount of debt we have or increase the assets. Alternatively, you could also provide more capital. So if we have capital contributions, that would mean our assets go up as well. So increasing assets. All right, the next one is return on assets, and this measures how effectively a business uses its assets to earn a profit. So here we're determining how well do we use our assets to earn the profit. This is shown in the formula net profit over average assets. Main ways to improve it are, firstly, we make sure we don't have too many excess assets, so not holding too much inventory or too many non-current assets. So trying to lower the amount of assets. Otherwise, we can improve revenue, better expense control, which ultimately improves profit. Now, following on from that, we've got asset turnover, which measures how effectively a business uses its assets to earn revenue. And this is measured by net sales over average assets. And the way to improve this, again, is ensure we do not have excessive assets, so holding too much inventory, but also just to improve our revenue. It's important to note our asset turnover will always be higher than the return on assets ratio, because return on assets uses the whole net profit, whereas asset turnover only uses net sales. The next one we're doing is gross profit margin. So this measures how much of business sales is retained as gross profit, primarily used to assess a firm's markup. So this is gross profit over net sales. And then how to improve that? We either lower our cost of goods sold or increase our selling price, with the net result being, no matter which one we pick, our markup percentage increases. Now, net profit here, this measures how much of our net sales is retained as net profit. And the main strategy to improve this, like above, is to lower cost of goods sold or increase our selling price, but also it's wider expense control like wages, lowering debt to lower interest, and any other cost saving measure. So just being aware of that there. Now, again, very similar to return on assets, asset turnover, gross profit margin will always be a higher number than net profit margin, because net profit margin deducts more expenses than your gross profit. And if you look at any income statement, you're going to see the gross profit is always higher than the net profit. Next, we've got our liquidity. So liquidity, first one, working capital ratio. This measures the ratio of current assets to current liabilities to assess the ability to meet short-term needs. So here it is current assets over current liabilities. Answer's always 2-1. And the best way to improve this is pay down our short-term debts, so keeping accounts payable low. And following on from that, we've got the quick asset ratio, which measures the ratio of quick assets to quick liabilities to meet our most immediate debts and obligations. And this formula is current assets less inventory and prepaid expenses over current liabilities, with the answer also being 1. And interestingly here, we take out inventory and prepaid expenses because inventory can't be turned to cash easily until it's sold, while prepaid expenses, you don't actually ever get a cash benefit from those, you only get the usage. So, like we've talked about previously, the quick asset ratio will always be a lower number than the working capital ratio, because current assets, you're deducting inventory and your prepaid expenses. So that will mean your assets are smaller. So quick asset ratio should always be lower than your working capital ratio. It can be equal, can never be higher. And then lastly, we've got our cash flow cover. And this answers or measures whether or not our cash from operating or day-to-day activities meets the financial obligations of the business. The formula here for that is net cash flows from operations over average current liabilities. And what we want to improve, or the way to improve this, is paying down our short-term debt again, increasing inflows across the board, i.e. more receipts from accounts receivable, minimizing our outflows. Next, we have our speed of liquidity, and this is inventory turnover first, which measures how fast we sell inventory. So we receive the inventory and we sell it. And so the way we measure this, and this is from the inventory chapter, average inventory over cost of goods sold times 365. Our answer is going to be in days. And main ways to improve this is appropriate selling prices, marketing mix. There's a lot of information on the previous inventory chapter. Next, we've got the accounts receivable turnover. How long does it take to collect cash from accounts receivable? So this is from the point of sale to when the cash comes in. We looked at this in the accounts receivable chapter. And the way this is measured is average accounts receivable over net credit sales plus GST times 365. Answer will be in days again. And how do we improve this number? The main way we improve this number is by offering discounts, having reminders, doing good credit checks, and offering good credit terms so people will be willing to pay back, having those positive customer relations. And then last but not least, we have accounts payable turnover. And this measures how long does it take us to repay cash to accounts payable. And this is from the point of receiving the inventory to paying it all back. And this is measured through our average accounts payable over net credit purchases plus GST times 365 with your answer being in days. And we always round up to the nearest day because likewise you want to go up. So how do we improve this? Always take advantage of discounts offered, clear communication, positive relationships. And the other way to improve accounts payable turnover is improving inventory turnover and accounts receivable turnover, because if we notice the inventory turnover 0.1 is the same as accounts payables 0.1 of receiving the inventory. Meanwhile, 0.2 of accounts receivable turnover, which is receiving the cash, we would immediately move that cash straight onto accounts payable or other obligations, which means that if you add up inventory turnover and accounts receivable turnover, everything working perfectly, you will get your accounts payable turnover in days. That's just a little pattern there to notice. So that is our speed of liquidity. This is how fast we can pay back our short-term obligations, with accounts payable being a really good measuring stick. Next, or lastly, I guess, we are looking at the vertical analysis. And I'm just going to put the vertical analysis on screen and I'm just going to unpack it here. Quite simply, you're going to notice sales revenue is 100%. That is because everything we compare it to will be that sales revenue amount. And if we have a look at gross profit, we see it's 53%. That means our gross profit margin is 53%, because 38160 over 72,000 is 53%. Meanwhile, if you go down all the way to the bottom, net profit is 20%. That means our net profit margin is 20%. This is another way to represent that profitability. Now, you can also use this to determine how our proportion of expenses, and this can help with expense control. So on that note, thank you so much for following along during the year. I wish you all the best in the exams. I wish you all the best in anything you need to do for accounting. And until then, see you next time.